Good afternoon and welcome to FASB, New Not-for-Profit Reporting Standards, the first webinar in the NADO Research Foundation's 2018 Professional Development Webinar Series. I am Lori Thompson, NADO's Deputy Executive Director, and on behalf of NADO, thank you all for taking the time this afternoon to participate in this webinar. Earlier today, I sent you all a copy of the slides that our presenter will use. We thought it would be useful to have them in advance so you can take notes as needed. Today's webinar and all of the upcoming webinars in this series are being recorded. Everyone that registered to attend today's webinar will receive a password-protected recorded version in a day or so. As I mentioned, this is the first in a series of professional development webinars that the Research Foundation will be offering until November. Please note the topics were determined with input from the NADO Research Foundation Advisory Committee, NADO and NADO Research Foundation leadership, NADO members, and other regional development practitioners. We will be launching the 2019 webinar series at the end of this year and welcome your input and suggestions for topic ideas. We have 5 more webinars scheduled after this one, and I'm working on 2 more. Topics range from the basics of social media for RDOs, ways for executive directors and senior staff to better engage their board members, communication strategies and public relations plans, and crisis communications. For more details about the webinars and to register, please visit the Professional Development Webinar Series page on NADO's website under the Events and Training tab. The web address is www.nado.org. Our trainer today is Jackie Bryant, a partner with Tate & Tryon, which is based here in Washington, D.C. NADO has worked with Jackie and Tate & Tryon for over 10 years as she and her team serve as our financial consultants. Jackie has over 20 years experience serving the accounting, consulting, and system needs of the nonprofit industry. Prior to joining Tate & Tryon, she worked in both the for-profit and nonprofit sectors. At Tate & Tryon, Jackie is responsible for overseeing all phases of their outsourced accounting engagements, including NADO and the NADO Research Foundation. Having worked with Jackie and her team since NADO secured Tate & Tryon to serve as our financial consultants, I can attest to her knowledge about the industry. I have no doubt you will all learn a lot during today's webinar. Before I turn the controls over to Jackie, please note that you can ask questions by typing them in the box on the side of your computer screen. Jackie will respond to questions at the end of the webinar. Also, as the webinar concludes, you will receive a prompt to complete a brief and easy evaluation. I hope you will take a couple of minutes to do that, as it will help us immensely as we plan future webinars. So thank you in advance for doing that for us. With that, let me turn the controls over to Jackie.
Okay, good afternoon, and thank you for having me. I appreciate everybody. Ooh, I think we're having, here we go. Appreciate the opportunity to speak with everybody. The topic today that I'm going to be talking about is some of the changes that have taken effect in the nonprofit reporting standards. And so this is something that has been affecting all nonprofits, you know, throughout, whether you are a C3, A6, C6, C4, what have you. A lot of different changes that are coming aboard that we want to make sure that everybody is aware of. What I've been telling a lot of the clients in my firm is that some of these will be things that you will want to put into effect right away during your fiscal year. Some of these things will probably not take effect until it's really time for the audit. And so I want to walk through each one and kind of give a high-level understanding of what those changes are. And then, as Lori mentioned, we'll take questions at the end. But also, if anything really needs clarity, you know, as I'm doing the presentation, I'm happy to stop, you know, throughout as well. So the agenda, as I talked about, is the nonprofit financial statement standards. That's going to be the highlight. Towards the end, there are just a couple things I'm going to mention as far as the tax update as they relate to nonprofits. Obviously, we all know about the new tax regulations that were passed and how they affect individuals and corporations. But there are a few changes in those rules that will have some effect on the nonprofit world. So I'm going to touch on those as well. And then obviously at the end, I'd like to take any questions that anybody may have. So the effective date of these new changes is really any time, any date after your fiscal year starting December 15th. So for the most part, if you have a calendar year, those organizations will have to put these new rules in effect right away. And then it just kind of eventually rolls out through any fiscal years that start after that. One of the things that you will see on here is that they talk about the key objectives and the reasons for these changes. They kind of consider, I know this is the accounting industry, which is my industry, but what their goal is not to make it more complicated, but their hope is to kind of improve the current model, make sure that people are able to read the financial statements a little more clearly, and make sure that you are able to understand, how the nonprofit operates. And so there'll be information that's in the financial statements as far as the numbers, but then also information that you will see when you go through the audit as far as notes that are part of the financial statements. So when we go through the presentation, basically there are 5 areas that are part of the changes in the new reporting regulations. They're the net assets, the way we look at investment returns, the way we do expense reporting, the statement of cash flows, and then the liquidity and availability of funds for the organizations. So I'm going to touch on each of these and kind of go through the highlights of what those changes are. So when we start with the net assets, this particular area is where your organization should be making the changes right away. Currently, when you're looking at your statement of financial position, and when you look at the net assets section of the statement of financial position, you will typically see whether you have unrestricted net assets, temporarily restricted net assets, or permanently restricted net assets. What the regulations are doing is they're changing the way those should be reflected. And now they're, instead of having 3 categories, they are breaking it down into 2 categories, and it's going to talk about whether it's with donor restrictions or without donor restrictions. And as you see here, without donor restrictions are obviously your unrestricted funds, and what they are doing is combining the temp restricted and the permanently restricted funds into one category. What will happen is you kind of have a choice on your interim statement whether you want to show a lot of that detail on those statements, but in the end, when it comes to the audit time, you will have to make sure that you are not only tracking that, which you should be doing anyway throughout the year, but being able to kind of have some more disclosures as to what those restrictions are. And what you're going to have to do is kind of indicate whether they are purpose restrictions or time restrictions. As you'll see in the next slide here, they talk about the 2 classes. With the donor and grantor imposed restrictions and time restrictions, you have to kind of look at whether they are, obviously temporary or perpetual. You have to look at whether there is a purpose. And so you really have to segregate it into those different categories. When we look at the without donor restrictions, one of the items you obviously have to look at is whether you have board designated funds. A lot of times what will happen is organizations will set aside a portion of their, what we were calling unrestricted net assets, for maybe a specific project or something that they're trying to develop in the future. However, that's something that the board or the organization has decided to do versus someone from the outside who has maybe contributed some funds. So typically when you have board designated, that is considered a without donor restriction. However, through disclosures, you would still want to separate those out. When we kind of look at the slide here, what it does is kind of give you some options for presentation. Typically, what our firm does for a lot of our clients, and again, this is a client choice, For the financial statements, especially for the interim financials, we try to keep it pretty simple. And so we will typically do what you see at the top, which is the minimum presentation required, where we just show in summary the amount that is without donor restrictions and the amount with donor restrictions. And what we do throughout the year as somewhat of a supplementary schedule is track those donor restrictions through a supporting schedule. What we've shown in the bottom here is a little more detailed, where when you look at without donor restrictions, you'll see how you have the undesignated, and then you will see that the board has kind of designated funds for certain operations or projects. And so you will see how they kind of itemize those. And same thing with donor restrictions. You see how you separate it, whether it's when you say perpetual in nature, obviously those are your permanently restricted. And then you also separate whether you have purpose restrictions or time restrictions. Typically, what you're going to see is more of the more detailed one that we have here in your final audited statements. However, you do have a choice, so that's one thing to realize. As we go on, the next area, and again, feel free if we need to stop in between, the next area that we are looking at is investment returns. Currently, on the investment returns, if you were to look at your current audited statements, and we totally understand, and we do this with our clients as well, on the internal financial statements, we always show a lot more detail when it comes to investments. We try to separate out whether you have unrealized gains or losses, realized gains and losses versus your interest and dividends. So we kind of like to track that separately for management purposes, so that we can see how the investments are doing. However, when it comes to audit time, you will see that investments will now be shown net. And so as a revenue line item, or even if you have it at the bottom of the line after operations, you will see just one line that says investment returns net of investment expenses. And so what they will be doing is taking all of your income or whatever returns that you've made on those portfolios. They will be subtracting out any investment fees and showing all of that as a net line item. Currently, a lot of organizations do this, so this is not a huge change in the way that investments are currently being reflected. However, one of the new areas, as you'll see in the second bullet point, is that they are expanding what they consider expenses to not be just external expenses. They are going to require that you allocate some internal cost to that investment activity. And what they're saying is, obviously the external will be your investment advisors that you have with the bank. But as far as internal cost, what they are looking at is that you should be including any salaries and related costs for anybody within the organization if they spend what they call material amount of time helping to manage those investments. So for instance, if your organization did not have an investment advisor and somebody within the organization was the person who was making decisions on an ongoing basis, kind of monitoring the activity, deciding when things need to be rebalanced, and taking a very active role in the investment process, then you are required to allocate some of their time to those investment expenses, and that's part of the net calculation that you have to provide. If the organization is, for the most part, passive and all of the work is done by your investment advisor, then that's something that you can kind of look at as far as whether there is a need to allocate internal cost to the investment activity. The other thing that will happen as far as investments is that, again, if you were to recall what your audited financials typically look like when there's investment activity, they will detail out, which is one of the reasons we are tracking the activity in the other way, is they will detail out realized, unrealized investment and dividends in separate line items, and typically do different categories of investments. As you'll see from the slide here, that will go away. And so there will no longer need to be that note. And again, for reporting purposes, you will only be required to show it on the face of the financial statements as a net activity. So the next area that we want to talk on is expense reporting. And when we look at expense reporting, again, most organizations, and I'm not going to say all, but most organizations, especially as a C3, typically have what we call a statement of functional expenses. And in addition, you have to kind of report somewhat of a statement of functional expenses on your Form 990. What the new requirement that is happening now is it is requiring all nonprofits to have this statement of functional expenses. What has kind of happened in the past is if you were a C6, and I believe even sometimes a C4, but I'd have to check, they were not necessarily required to have that, and not necessarily always having that on the audited statements. They could just show the main natural categories. The requirement here, however, is that it will be a requirement to have it, and in addition, you will be required to disclose what methods you are using to allocate some of those expenses from your G&A to some of your programs. What has also happened, even though, like I said, most C3s have been doing the statement of functional expenses, what has been a big change is that they have provided guidance now as to what exactly is management in general or admin expenses, and kind of dictating what kind of costs can be allocated and what cannot, as far as kind of what we talk about a direct cost. And we'll go through that in just a second. So what we have here is just kind of a sample of what you should be showing. And so this is a typical statement of functional expenses that we see for most organizations. You'll see where you outline your different program services, your management in general, and then your fundraising, and then have a total. And so, again, this is kind of the typical presentation. You probably have some options as how you want to present that. So there is a little bit of flexibility there, but this is kind of what you would have to show. What we have here is in separate from having that statement of functional expenses like I showed previously, the other option is to kind of show this as a more kind of more linear, kind of, well, I shouldn't say linear, vertical level, where you have it kind of going up and down versus across. I think this is a little, this presentation here is going to make your financial statements pretty long. So I would foresee that most organizations would do the prior slide, which I think makes a lot more sense and is a lot easier to read. The previous slide also allows you, if you kind of look what we had previously, it allows you to kind of see across, like if you're comparing salaries amongst the different programs, you're able to easily see who has the most, kind of where those percentages are. So the other thing, as I mentioned, when we talk about the statement of functional expenses or the expense reporting, is that all nonprofits will be required, and this will be a new disclosure that you will have to develop at audit time. You don't really need this on the interim unless you do a lot of notes with your interim statements. But the new thing was that you will need to be able to provide an additional note in the financials that talks about, for the most part, you want to talk about your allocation process and how that is used. to allocate a lot of the G&A costs. And so they have an understanding of how those costs are being put into different programs. And so here is where I guess really where the newest item is. As I mentioned earlier, we talked about FASB has really starting to dictate a little bit more what things are considered management in general. And so they've kind of outlined some of these costs. What we're finding is that the big thing that we're seeing with a nonprofit is that if you look here, we're talking about kind of that second kind of purple box that you see when we look at grant and contract financial reporting. A lot of times what we would find would be organizations when they have a lot of grant work, and some of the grants will allow it, is that you could allocate like accounting fees or some type of fees or audit fees as it relates to the grant, because there is specific reporting that is required just for that grant. It's not a reporting like you're doing your financials for the whole organization. And so you would have an allocation of cost directly to the grant. What the new regulations are stating is that currently now those costs need to stay in management in general. And so one of the things that we're finding is that we're kind of coming up with different mechanisms, and what we've kind of come up with having two different kind of management in general categories, where you have one management in general category where you have to keep it in management in general, and then another category that allows for costs that can be allocated to different programs. So I think, again, when we're talking about some of the changes in the regs overall, this is one area where I suggest that organizations really take a look at what their allocation process is. Here's another kind of listing of some of the guidance that the that the FASB rules have dictated. I think one of the big things that you kind of look at here is when you look at kind of like your CFO or your accounting, maybe you have an accounting department, and what they're saying here is that, again, your accounting or CFO should all be management in general. Again, what we saw in the past was that as a CFO, you're kind of working with all the different programs. You're helping them to understand their financials, helping them to forecast and budget, and like we talked about, doing some of the grant reporting. And so a lot of times we would see that some of those accounting costs, or that CFO, like when you're allocating salaries for the CFO, they would be allocated across multiple departments. And what the regulations are saying now is that typically that CFO cost needs to stay in management in general. You can see that the CEO can be allocated, which is great, but the CFO must stay in management in general. And they have very specifically outlined the grant accounting and reporting, as we see on the bottom, that all of that, whether it's a grant-related report as far as the program reports, I think that's another big one to look at, is that program reports can be grant-related, so that's fine, but the financial reports for that grant must stay in management in general. So the next area that I wanted to touch on is the statement of cash flows. Excuse me. And so in this area, the statement of cash flows typically is something that we generally just see in the audited financial statements. We don't find very many organizations who create these throughout the year as part of their reporting package. So I don't think this is a huge issue as far as the change, but what I want to just make everyone aware is that what they have done is they have given you now a choice as to how you present that statement of cash flows on your audited statements. I don't know if many know, there are actually two methods. There's a direct method and indirect method for presenting cash flows. For the most part, in the past, you had to show your statement of cash flows in the indirect method. Now they're giving you a choice to do the direct method. So you kind of see that at the bottom. And so again, you know, I would work with your auditors and or your accounting department to see what that looks like. And you would have to find, you know, really it's about what is most beneficial to the readers of those statements. I believe that most people will continue with the indirect method. However, you know, depending on what's important, you could see some people moving towards the direct method. I think the good thing is you do have a choice here. And so the final area when it comes to the FASB changes is the liquidity and availability section. Now this is brand new, totally new area that has been added. And so this is something where, again, not necessarily something that you will need to have for your interim financials, but it is something that you would want to be prepared for when your auditors come in and you have to do your audit reports. And so what this is going to be a combination of and these are going to be part of the notes to the financials, but it's going to be a combination of showing a calculation and then a description about the assets that the organization has available for general expenditures, and they need to be current assets. So what's available within a 1-year period from the balance sheet date. And what you're doing, what I have here, as you look through the slide, what I have here is an example of a disclosure. And so, you know, what it is doing is describing how the organization maintains enough liquid financial assets in order to meet general operating expenditures. And so what this does is actually come in combination with, and is probably should, to kind of get people to think about making sure they have some type of reserve policy. As hopefully most people know, there's usually a recommendation that an organization has anywhere, and a lot of organizations vary, but it could be anywhere from 3 months to a year worth of reserves to cover operational expenses. You want to be able to accumulate that should something happen, that you could continue to operate. And so what this disclosure does is kind of tie into that. And so what they want to know is how does management review that? How do they calculate that? And kind of what is the goal of the organization to make sure they do have enough liquid assets to cover any expenses. So in addition to the disclosure, they also are going to want you to calculate those. And so here is an example of the calculation where you would take your cash and cash equivalents. You would look at if you have any accounts receivables, any short-term investments, and any other type of current assets that you could use to cover operating expenses. One of the clarifications that we had to work through with even our audit department is, as you know, I mentioned earlier that sometimes organizations may have what we call board designated restrictions or net assets. And so depending on the nature of those board designated net assets or restrictions, you will need to determine whether you need to include of any cash or liquid investments that you have to cover those board designated, or if you want to exclude that. There was a lot of communication back and forth as to what that is, but I think it's more of a decision as to looking at the nature of the board designated to determine if that should be included. So again, what did you need to do when it comes to that? Is probably especially relates to the liquidity, is making sure that you have, and also really I guess for the expense allocations, to make sure you're kind of looking at, do you have policies and processes that are documented so that when the auditor comes in, they can say, yes, this is my policy for allocations, this is my policy for allocating if there's any internal cost to investments, this is how we're doing our liquidity as far as our cash reserve. So it would be a good time to kind of review that you have the relevant policies and procedures in place so that you can use that to help to drive that narrative. And then, making sure that, you're conveying the message that you want to convey. A lot of times if you're applying for grants, many times grantors are looking at that auditor report, they're requiring that. And so, making sure that the right disclosure and that the right information are part of your notes is going to be an important part of this, piece of the puzzle here. So Lori, I think before I go into the tax area, I think this might be a good time possibly for if there's any questions on the FASB regs. Or
Jackie, so far, yeah, so far nobody has submitted a question. So
okay, we'll keep it moving.
If they do, I'll break in. Okay.
Okay. So what I wanted to, so obviously we went through all the new FASB regulations, and that has to do with how the organization is reporting expenses, items that you will see on your audit report when it's come times for that. But the other thing I just wanted to kind of touch on, as I mentioned earlier, is some of the changes that we have based on the new tax regulations and how they affect nonprofits. As we mentioned, everyone talks about the corporate changes as far as the corporate tax rate. Obviously, there's been the individual provisions as far as the tax brackets for that. But what is really not talked about too much is how those in turn affect the nonprofit. And so what we have is that obviously the new corporate rate is 21%. What this will do is, should your organization have unrelated business income tax, this could have an increase in your tax rate. Based on the size of your unrelated business income tax, your UBIT, you could be in a 15% tax bracket for that. And so obviously going to the new tax rate, that will increase to 20% for the nonprofits as well. And so that is some area of concern. And then obviously it also is going to be an effect on if you have any proxy tax on your lobbying expenditures. So that's one area to be aware of. Again, when we talk about UBIT, in the past, if your organization had UBIT, you would take all of the different activities that you may have, combine that into one as far as total revenue for all, total expenses for all, and then the hope is that you've been able to allocate enough expenses to cover that revenue, and the net would be zero and there's no tax. The change has been that you now need to separate out the different activities. And so you could have different rates for each activity. They're going to look at them separate. So you could have advertising, and maybe you're making a whole lot of money in advertising and you have a huge profit, or maybe you have some passive royalties, or I should say you're active in your royalty process, and so that's unrelated, and maybe you're not really making any money there, and that's a loss. Well, in the past, you could net those two activities. Now you have to look at each one individually and pay the tax on each activity. The biggest area that is really hitting nonprofits, and this is all nonprofits, is right here when we talk about fringe benefits. And so this has been a huge issue. there has not, the IRS is slowly providing kind of guidance in some of this area, but unfortunately so far that guidance has not been to the positive, though, hopefully as things move forward, some of these lobbying areas or associations will kind of get this to the forefront. But the effect right now when it comes to fringe benefits is that the IRS and the new regulations have now stated that anything provided by an organization for transportation benefits is considered UBIT. So as we talked about earlier, we talked about those rates. They are saying that if you provide parking, and that's whether you provide it pre-tax or after-tax, for your employees, that expense, and I know we're talking about an expense versus looking at a revenue, but they're considering that expense as unrelated business income activity. And so there's a tax on that. And so this has been a huge area where people are scrambling. We are slowly working through a lot of our clients currently to kind of look at that. But that is an area where if you are providing those fringe benefits, you want to look at what is the cost of that. And we are strongly suggesting that you start to make some type of kind of tax deposit, estimated tax deposits throughout the year, because this will require you, for many organizations who have not filed a 990T in the past, to have to file one moving forward. So this is a very big area that you want to make sure you're on top of and be prepared that at the end of the year, if you are providing these, that there will be a change in how this is reported on your 990 and could result in additional expenses. Obviously, people are looking at, what are the different options to work around this. That depends on if you're small or if you're larger. Obviously, if you're in DC, locations matter as well. I know in DC, if you're located, anybody with 20 or more employees are required to provide these benefits. So those organizations are kind of stuck. We have some organizations who are like, well, it's not, when you look at the actual tax, it's not that material. They'll move forward and do what they're currently doing. Some organizations are looking at to see if there's another way to kind of provide those benefits. But this is a very big area that is actually hitting I should say all nonprofits. That's whether you're a C3, C6, C4, what have you. So definitely want to look at that. The other area is some lobbying expenses. I don't think this may hit some organizations, but not too much. So I just kind of put that in the slide here so that you're aware of it. But just certain lobby expenses are no longer deductible. So that's an area to look at. That's going to be more effective on the C6s when you're calculating the non-deductible dues portion. And then this area, we don't have very many organizations who will see this issue. If you do have this issue, you're in a very good place. But what it has done here is that there is a new excise tax on any nonprofit who has an employee with compensation over $1 million for the year. And so that is a new area. What they've also done is make some changes in your operating loss carry forward and carry back. You used to be able to go back if there was a loss and carry it back to cover previous returns or previous revenue items to offset that. That's been eliminated. However, you are able to carry operating losses going forward indefinitely. And so then the final area that is kind of the big unknown that we are seeing with a lot of our nonprofits is that obviously because of what is happening with the individual tax rate and the changes, many people, even though they are getting increases for most people in their tax, in their paychecks because of the new rates, what is somewhat of an unknown for many is that with the change even though there's a change in the rates, there's also a change in a lot of the deductions. And so different folks, depending on what area of the country that you live in, if you're in one of those high high tax states, they're not really sure what their bottom line is going to be when it comes to tax time. And so what we are seeing and what the concern is that perhaps until that kind of studies, folks who give like personally to different charitable organizations, there's not as much of an incentive right now unless they can use that deduction. And so right now, while there's an unknown, there is a concern about if the level of that will decrease. I'm sorry. And so we are seeing that organizations are preparing that there could be kind of a decrease in the contributions, individual contributions that they're receiving during the year. So this is the presentation. I'm not sure if I did that, Lori, or not. Oops. Any questions?
Jackie, you must have done a great job explaining it because there's really no questions. The only question I did have was somebody was asking for clarification about would the webinar be recorded, and it will be. And as a reminder, we will send the link out to everybody who registered to attend at some point, I think by, if not tomorrow, then early next week. But that's it. I'm checking now, and I don't see anybody writing any questions in. So again, I think you must have done a very clear job of explaining things.
Well, hopefully everything was clear, and hopefully that was helpful for everyone. And I'm sure I'm available. Lori knows how to find me, obviously. If there are any questions that comes up afterwards, I'm happy to answer anything that should come up subsequently.
Yeah, and I guess if anyone has questions, they can just let me know, and I can connect them with you, Jackie. So before we close off, I just want to remind folks that the next webinar in the series will be June 14th, and it will look at the role of social media within regional development organizations, and take a kind of a dive at what's the best form of social media to use, when should you use it, how to use it, that kind of thing. So it should be pretty relevant and informative. And just a quick reminder that before everybody hangs up, they will get a prompt to do the evaluation, and I hope you will do that so we can learn from you how well things are going and get ideas for new webinars. So with that, I think we can hang up. And again, if anyone has questions, just please feel free to let me know, and I'll reach out and connect you guys with Jackie. So thank you very much.
Thank you.